Yes, there are pathways, what I call approaches. You know, there's a formula is different from an approach. A formula says if you do this and you do this and you divide by 2 and multiply by 1.3 and take away 4, you'll get the right answer. But that's what I mean is an approach. In fixed income, in high yield bonds, we have concluded that the most efficacious way, most reliable way to pursue success is through the avoidance of defaults. Not through the pursuit of upgrades or takeovers or other salutary events, but through the avoidance of negative events. Why? Because as I say in the memo, we're talking, oh, no, that's a different memo. As I say, it's fixed income investing. And all the 8% bonds that pay, roughly speaking, are going to pay 8%. So it's not really that effective to paw through all the 8s that are going to pay to select the ones that are going to make a little more than the others. You should spend all your time finding the 8% bonds that aren't going to pay and making sure you don't hold them. And I haven't had a chance to read the 1940 edition of Graham Dodd a few years ago, and they describe fixed income as a negative art. You add value to a portfolio not through what you include, but what you exclude. So, again, that's an approach. Now, how you do it is, something that you have to have skill for. And, you know, if they say, well, exclude all companies that have debt equity ratios over 4 to 1, you know, well, some companies that have debt equity ratios over 4 to 1 you can hold, and some that have 3 to 1 you can't hold. So that's what I mean by a formula, a quantitative rule that's different from a thought pattern or an approach.